Hello, this is Alicia Sisk-Morris, and today I'm representing Team Echo at Western Carolina University's ENT 640 Summer 2015 class. I will be discussing today financial ratios. So what are financial ratios? Well, a financial ratio is a financial analysis comparison in which one financial statement line item is divided by another financial statement line item, and they reveal, through their ratios, logical interrelationships. As you can see, some people think they're in pretty good shape because they believe that nobody understands their financial statements. Well, if you understand ratios, then you'll further be able to understand financial statements at a considerably deeper level. There are primary financial ratios. Some financial ratios are called primary because they indicate the fundamental causes underlying a company's strengths and weaknesses. Some examples of these ratios would include net sales to net worth ratio or net income to net sales ratio. The secondary financial ratios would consist of other ratios that depict the company's competitive position and financial structure as effects of the causes identified by the primary ratios. Some examples would include current assets to current liabilities ratios and current liabilities to net worth ratios. Some financial ratios are based on the balance sheet line items, while others are based on income statement line items. Here is a sample balance sheet for us to take a look at, reflecting the assets, liabilities, and stockholder equity of a company with a year end of December the 31st, 2014. Let's take a look at some of their ratios. First ratio we'll share with you is called the working capital ratio. It will comprise of taking the current assets and subtracting the current liabilities. So we can see here our current assets of $89,000 will be subtracted from our current liabilities of $61,000, giving you a positive number of $28,000. Here's where these numbers were coming from. Here's our total current assets and our total current liabilities. This number is an indication of whether the company will be able to meet its current obligations. In other words, pay its bills, meet its payroll, make a loan payment, etc. If a company has a current asset exactly equaling its current liabilities, it has no working capital. The greater the amount of working capital, the more likely it will be able to make its payments on time. Another ratio is called the current ratio, and it's taking these same numbers but dividing the current assets by the current liabilities. This ratio will tell you the relationship of current assets to current liabilities. So for an example, a ratio of 3 to 1 is better than a ratio of 2 to 1 or a ratio of 1 to 1. A ratio of 1 to 1 means that there are no working capital. There's a quick ratio, also known as the acid test ratio. And what that takes into consideration is it will take our cash plus, and this is our petty cash and our regular checking account cash, plus our investments and accounts receivable, and we will divide that by our current liabilities. And our ratio in this example will be 0.86 to 1. This ratio is similar to the current ratio, except that inventory, supplies, and prepaid expenses are excluded. This indicates the relationship between the amount of assets that can be quickly be turned into cash versus the amount of current liabilities. Another ratio for the balance sheets you can take into consideration is the debt to equity. We take the total liabilities and we divide that by the total stockholder equity. So in this example, we'll take $481,000 and divide it by $289,000. And we get a 1.66 to 1 ratio. This is the portion of the company's assets supplied by the company's creditors versus the amount supplied by the stockholders and the owners. In this example, the creditors have supplied $1.66 for each dollar supplied by the stockholder. Here's where those numbers can come from. As you can see, here's our stockholders' information, as well as our liabilities. Down here's our assets, and up here is our current assets. So you can see that all of the numbers on this form has come back to show up in these ratios here and here. Next, we will move into discussing the income statement. Here's an example of that same company, but we're going to instead look at ratios that are common or derived from the income statement. So we've got our sales, our cost of goods sold, and our profit. Then we have our operating expenses. We'll have our operating income, interest expense. We'll have our income before taxes, our taxes, and then our income after taxes. Let's take a look at some of those ratios. The first one we'll look at is the gross margin, which is gross profit divided by net sales. So in this example, we'll have $120,000 divided by $500,000. So our gross margin is 24%. This indicates the percentage of sales dollars available for expenses and profit after the cost of the merchandise is deducted from the sales. The gross margin varies between industries and often varies between companies within the same industry. Now, our profit margin after tax would consist of net income after tax divided by sales. So in this example, we are now at 4.6%. This will tell you the profit per sales dollar after expenses are deducted from sales. This margin will vary again from industry to industry and from company to company, even within the same industry. Earnings per share. We will take the net income after tax and divide it by the weighted average number of common stock shares. Remember, it's just common stock shares. So in this example, we'll take $23,000, divide it by the common stock outstanding of $100,000, and we're getting 23 cents per share. This will express the corporation's net income after taxes on a per share of common stock basis. The computation requires that a deduction from preferred dividends from the net income if a corporation has preferred stock. Also requires that the weighted average number of shares for a common stock during a period of net income. Another ratio is called the times interest earned. We'll take the earnings for the year before interest and income tax and divide that by interest expense for the year. So in this example, we'll take $40,000 and divide it by 12,000 and come up with a ratio of 3.3. This will indicate the company's ability to meet interest payments on its debt. In this example, the company is earning 3.3 times the amount it is required to pay its lenders its interest. Return on stockholders' equity after tax. This ratio consists of the net income for the year after taxes divided by the average stockholder equity during the year. So in this example, we'll take $23,000 divided by $22,780 and come up with 8.3%. This will reveal the percentage of profit after income taxes that the corporation earned on its average common stock balances during the year. If a corporation has preferred stock, the preferred stock dividends must be deducted from the net income. Here's a few more ratios. There's the accounts receivable turnover, which is where we will take the net credit sales for the year and divide that by the average accounts receivable for the year. This example yields a 11.9 ratio. This is the number of times per year that the accounts receivable turns over. Keep in mind that the result is an average, since credit sales and accounts receivable are likely to fluctuate during the year. It is important to use an average balance of accounts receivable during the year. Next, we can look at the days sales in accounts receivable. So there's 365 days in a year, and you divide that by accounts receivable in the year. And in this example, we will come up with 30.67 days. So that means the average number of days that it took to collect the average amount of accounts receivable during the year. This statistic is only as good as the accounts receivable turnover figure. Inventory turnover. This is where we take the cost of goods sold for the year and divide it by the average inventory of the year. In this example, we come up with 12.67. This is the number of times per year that an inventory turns over. Keep in mind that the results is an average. Since sales and inventory levels are likely to fluctuate during the year, and since inventory is at cost, not sales value, it is important to use the cost of goods sold. Also, be sure to use the average balance of inventory during the year. Next, days sales in inventory equals 365 days in a year divided by inventory turnover in a year. In this case, we have 28.81. That's the average number of days that it took to sell the average inventory during the year. This statistic is only as good as the inventory turnover figure. One of my favorite quotes is from Warren Buffett, and he indicates that risk comes from not knowing what you're doing. Ratios help you understand what you are doing. How do you learn more? Well, first you can take some accounting classes either at Western Carolina, UNCA, or even at your local community college like AB Tech. You can invest in accounting software. This will help you create financial statements to which you can use in order to calculate your own financial ratios. And finally, I share with you some reference materials that I used for this presentation. If you have any questions, feel free to reach out to me. Again, this is Alicia Sisk-Morris. I'm a CPA in Weaverville, North Carolina. Have a great day.